Welcome to Orange County Power Players, where we spotlight the personal, professional, and financial success stories of OC's top leaders. Here's your host, Danny Flores.
Welcome back to OC Power Players, where I interview some of the most successful people in Orange County. I'm Danny Flores, your host, and today's honored guest is Harold Hofer zooming in from Newport Beach. Harold is a real estate investment opportunity creator with Alture Funds. Harold or companies under his control have sponsored REITs, limited liability companies, and limited partnerships that have purchased commercial properties throughout the United States exceeding $1 billion in value on behalf of thousands of investors, large and small. Harold has served as board chairman for 4 public REITs. Welcome, Harold.
Thank you, Danny. Thanks for having me.
Sounds like you're very involved in the real estate business and the investment side of it. How did you get there, and how long have you been involved?
Pretty much my whole professional career. I grew up in the LA area, went to UCLA, moved down here to Orange County when I got out of college, and actually was a lawyer as well, went to UCLA Law School in addition to undergrad. So I practiced law down here for a couple of years, but then I got in the commercial real estate business. Gosh, that was back in the 1980s. And had a small company that I sold to the coal company, KOL, here locally in Newport Beach. That was, say, in the mid-90s. And I met a guy named Ray Werta at that time. Ray was running the coal company at that time. And fast forward a little bit, Ray took the management company at coal, merged it with what's today's CBRE, but ultimately became the chairman and CEO of CBRE, the world's largest real estate services company. And Ray and I stayed in contact all through all that time frame. Fast forward to 2012, the Jobs Act came out. You may have heard of the Jobs Act before. It jumpstarted our business startups. So the idea of the Jobs Act was to expand the way people could raise capital, primarily from accredited millionaire type investors, but they made it easier to solicit capital for Reg D private placement type deals from millionaire investors. But it kind of set a light bulb off in our heads, Ray's head and my head, maybe more Ray's than mine. But the idea was, hey, if people are going to start using the internet to effectively raise capital for real estate investing through this Jobs Act thing, maybe we could do the same thing for larger deals, larger REITs that are not traded, but that are open to non-accredited, non-millionaire investors. It's called a non-traded public REIT. So we started a company called Rich Uncles back in 2012. Ray and I did. And the idea was, hey, we're going to have our own little REIT with small minimum investments on a website, and people that want to buy little shares of large portfolios of real estate could do so through our website, and it was called Rich Uncles. So we started out in California. We had a public offering, so it was not publicly listed anywhere, but it was publicly registered with this Department of Corporations here in California that allowed us to solicit investors for non-millionaire investors for small amounts of investments. I think our minimum investment was $2,000 at the time.
Wow!
So it was a $25 million fund. We started here in California, and it was pretty successful. We kind of blew past the 25 million. We upsized it to 50 million, blew past the 50 million, upsized it to 100 million, and kind of approached the $100 million level of capital raised from individual investors, thousands of them, tens of thousands of them, and said, well, let's try to expand this thing nationally. Let's do a fully registered, SEC registered offering, open to the public, not publicly traded, but open to the public in terms of being able to solicit capital, and let's do that. So our product type was single tenant net lease, which is kind of an income focused, kind of low risk income focused type real estate investment. And we had a lot of tailwinds at our back. Interest rates were falling, cap rates were falling, so we're looking kind of like superstars because our performance was really good. And but at the end of 2018, we're about $500 million now of assets under management. 2018, $500 million. And we had a really big company. We had a kind of a real estate side of the company, a SEC reporting side of the company, which was half the company. And then the other half of the company was tech, marketing, product. How do we engage people to come to the platform to begin with, make an investment, then the money would flip over to the real estate side, and we have to invest it. So, but we ended up selling the company, the management company, the parent company of Rich Uncles, to the REIT itself, and took both of them public. They became a publicly traded, still are today actually, a publicly traded New York Stock Exchange listed REIT. And that was kind of the exit, so to speak, for the people that invested in our platform company. But Ray, smart guy, obviously, he said, we've this real estate wave we're on, the post global financial wave that we were on, with again, cap rates coming down because the interest rates are coming down. A lot of money plowing into real estate ain't going to last forever. It's tough to predict the bottom in markets, tough to predict the top. But Ray said, I think we're getting close enough to the top. Let's button this thing up and take it public, which we did. But after that, during the whole course of this evolution, and stop me anywhere, Danny, if you have a question. But during the whole course of this evolution,
what year are we in now?
We're now in 2019. We took the company public during the course of 2019, and we hired a successor CEO, a guy that was more of a Wall Street type guy that had experience with taking companies public and that sort of thing. And so I got out at that time as CEO, and Ray and I both kind of exited at that time, and our investors. But during the course of the same 2010s, the 2010 to 2020 decade, other things were evolving similarly. These little fintech apps came into play where people could invest money not just in real estate but stocks and bonds, like through Robinhood, or investing apps like Wealthfront or Betterment, where you could have money invested for you from a digital financial advisor rather than a human financial advisor. And those became very popular. And you may have heard of the app based here in Orange County, Danny, called Acorns. I don't know if you've heard of Acorns before. So Acorns is a micro investing app formed here in Newport Beach by Walter Crutton and Jeff Crutton, a father-son duo. And Acorns, last time they raised capital, they had a $2 billion valuation, so it's been enormously successful. But I knew Jeff, I knew Walter, and I knew Walter's other kids. So Walter had another son named Alex. So I kind of recruited Alex, say, listen, we had this business called Rich Uncles, and it was successful, but maybe we should try it again with a little more emphasis on product design and tech and advertising, because that was really, we were kind of trying to be two masters, trying to serve two masters with Rich Uncles. One is a real estate master. Okay, where do we invest it? How to invest it? How do we direct a real estate acquisitions team, the finance team, the leasing team, the management team, on the one hand, and on the other hand, okay, how do we get people to this website and create a compelling, user-friendly journey to buy shares in our Rich Uncles REIT? So Alex and I have formed a company called Alture Funds because, Alex had all this experience with Acorns. He was in college when Acorns was formed, but he was kind of, at the kitchen table hearing everything. And he was kind of one of the first guys to actually develop a website where you could buy shares of a security or an investment, whether it's real estate or anything else. So he's a really sharp, intuitive guy in that regard. I'd say one of the top guys in the country in terms of that talent level. But again, let's go back to the same 2010, 2020 timeframe. Big, huge alternative investment sponsors like Blackstone primarily, but many others said, we've been raising money from institutions for decades, pension funds, endowment funds, foundations, sovereign wealth funds, blah, blah, blah. And they've raised, hundreds of billions of dollars each, trillions of dollars collectively. And say, where's the next frontier for us to raise capital? Because we're kind of tapping out these big, huge institutional investors. We've kind of hit CalPERS for every strategy we can think of from an alternative investment basis. So they said, okay, we're going to go to the public. We're going to create a vehicle to raise capital from the public. And so Blackstone, for example, formed this thing called Blackstone's BREIT, Blackstone Real Estate and Income Trust, and it was registered with the SEC, just like our old Rich Uncles deal was. Open and not accredited, not a million investors, just like our old Rich Uncles deal was.
Is that like a Reg A plus type of?
No, it's a fully registered REIT. So Reg A plus, you're limited like $75 million per year that you can raise. Right. Blackstone was raising that in a month. I mean, when they got going. So they raised ultimately, gosh, I think it was $60 billion in this BREIT since 2017, and they weren't alone. It was KKR got in that business, and Starwood and Ares and Apollo, all these big companies said, okay, there's this we've built this huge infrastructure of managing, finding and managing and administering alternative investments, not just real estate, but private credit, private equity, infrastructure. Where else can we layer in additional capital with really no marginal cost to us to administer the capital because we have the infrastructure built? So they went to the general public, and it's been enormously successful. All these big firms. And last year, for example, according to an investment bank that tracks this space, about $130 billion of capital was raised for so-called alternative investments through the so-called retail channel, which is, human wealth advisors, $130 billion. $80 billion of that was through these public programs, these programs that are available to non-accredited, non-millionaire investors like Blackstone's B REIT that I mentioned earlier. The balance was, private placements, Reg D type deals. But Blackstone and others have built this huge army of wholesalers that effectively go to every broker-dealer and every registered investment advisor in the country. They have territories. And they say, hey, you got to sell our deal. Here's what's happening. But it's been incredibly successful. Our thesis currently with Alture Funds, Alture Funds, Funds, that's our website, alturefunds.com, is that the next avenue of expansion for these large, alternative investment sponsors is that portion of the investing public that does not have a human wealth advisor. An increasing amount of capital in the U.S. is self-managed, where people manage their own investments. They haven't hired a broker at Morgan Stanley or an advisor at UBS or whatever. They manage their own money, and it's only going to accelerate, I think, because I think the digital native class of people, they've been doing it with Robinhood and Acorns and Rich Uncles maybe before that. And it's kind of an ingrained behavior for them. There's a lot of tools online where you can figure out how to invest and what to invest. You really need a human wealth manager to layer in on top of that. So the idea is that as so much of capital in the U.S. is self-managed, why aren't these Blackstones and Ares and Apollos and Starwoods presenting those deals to the general public? So that's why we formed this company called Alture Funds, because we think that's where the next wave of capital is going to come to these big, huge alternative investment sponsors, is from that portion of the investing public that does not engage a human advisor, a human wealth manager. So we have signed a deal with a big player in that space called Blue Rock. Blue Rock actually has an office here in Newport Beach. They're based in New York, but Blue Rock is kind of like a Blackstone. They're top 10 player. Blackstone's clearly number one in the alternative investment space in terms of being a sponsor. They manage over $1 trillion right now. Blue Rock's a big player in that space as well. Not $1 trillion, but they're a top 10 player. And so we went to them, went to about half a dozen of these firms. We went to say, listen, your next avenue of raising capital beyond this human wealth manager army that you've accumulated over time through the U.S. is direct to consumer. Let us be the conduit through which you can start exposing your deals direct to consumer. So Blue Rock has a private credit deal, which is primarily collateralized loan obligations that they syndicate effectively to consumers. They're in a $3 billion pool of CLOs that they fractionalized into $2,500 increments that you can buy, it's a piece of for $2,500. And they have a private real estate fund as well, also $2,500 minimums. So
just so that real quick, so that people understand, when they invest $2,500, what kind of returns do they get? Because it's alternative investment, so it's going to be higher than what you can normally get.
Right. So currently, past performance is not a guarantee of future results and all those other disclaimers, but Blue Rock's private credit fund pays 11.7% annualized on a quarterly basis, and their real estate fund pays 5.25% annual distribution on a quarterly basis. So 11 north of 11%, almost 12% on their private credit fund. Again, paid quarterly, one fourth of that, and the real estate fund 5.25%. Paid quarterly. Now, with real estate, you're hoping to get capital appreciation in addition to that distribution and tax benefits. Again, who knows what's going to happen in the future, but that's a thesis, is that 5.25% is just a portion of what your ultimate return might be as an investor, because they track this thing called NAV, or net asset value, they being Blue Rock. They track it and recalculate it every single day. So you buy a share today, Blue Rock, the NAV could be $25, tomorrow it would be $25.02. So who knows? But they calculate a net asset value per day, and that's the price at which you buy shares every single day. The private credit fund, their goal there is to kind of have a static, unmovable NAV per share. They're trying to distribute all the interest they collect effectively to the shareholders, and because these are all primarily floating rate interest loans, so they're not really exposed to rising interest rates or declining interest rates. They move lockstep, but so those are the yields, the distributions that they're paying, and these are huge. I mean, Blue Rock's real estate fund is a $4 billion fund. I mean, it's a huge, huge fund. Been around quite a while.
Right.
And so if you're looking at our company, Alture Funds, it's you, Harold, and Alex, and others. You're not really investing with us. We're just a conduit through which you can gain access to these previously inaccessible funds that are open to
Right.
non-millionaires like yourself, Mr. Investor,
Right.
but unless you had a broker-dealer or a financial advisor, you couldn't access them. Now you
Right.
can. So our business model is to bring these huge legacy, large alternative investment funds that have been available to the general public for, say, 8 years now, when Blackstone started back in 2017.
Right.
The next element of expansion for these folks is direct to consumer over digital interface like ours. So currently we have this private credit fund that we mentioned, a private real estate fund we mentioned. We want to add an infrastructure fund. We want to add a private equity fund and a hedge fund. So those are the five main food groups within the so-called alternative investment space. Going back to Blackstone, for example, of the $1 trillion plus that they manage, about a third of that is real estate. You think, wow, don't they all do all real estate? No, Blackstone, it's only about a third real estate. Another third is private equity. Another third is a combination of private credit and other things. So alternative investments span a lot of things beyond real estate. You and I would just think of it, well, it's real estate, right? Well, yes, that's a big part of it, but there's other things besides real estate that would fall in the bucket of alternative investments, things that are not traded on exchange every day, and stock exchange every day, and generally have higher yields because of the so-called illiquidity premium, because you can't get your money out every day, that you want a higher return.
Right.
And so forth. So that's why alternative investments exist in places like CalPERS just published. They have a 30% allocation of their funds in alternatives. You think that's a big chunk of their, I don't know, 500 billion. I forget how big their the CalPERS is these days.
Yeah.
Maybe it's trillion. I don't even know what the number is, but it's a
Yeah.
huge pension fund, and a third of it, or 30% of it, is now slotted into alternative investments, private equity, private credit, private real estate. So that's kind of who we are, what we're doing. Just kind of, pause for a second. Any questions, thoughts, other issues regarding that, or?
That's a lot of information, but I think the biggest takeaway for our audience is that you don't have to be an accredited investor or super wealthy millionaire to invest. Now,
Right.
if you don't have as much money, you can actually do smaller investments.
Right.
Now, in your fund, and where a lot of people have money, would be maybe like in IRAs, and many people think that money, retirement accounts that have money, they can't touch them and put them in alternative investments. I am sure you take those accounts as well,
Right.
right?
Right.
But they have to be
Yeah.
done through the custodian. Can you go through that and how
Yeah,
you can help somebody
it's
in that position?
easily done. So a self-directed IRA, where you are kind of managing your own money. You have a third-party custodian that's technically legally, running your account, but you're effectively running it as a self-directed IRA. Back to my rich uncle's days, about a third of the capital that we raised was through self-directed IRAs. There's a lot of big money, and it's a great. These sort of alternative investments, longer term, good yields, longer term investments are well suited for self-directed IRAs, where you're not going to touch the money for 5, 10, 15, 20 years, whatever it is. So yeah, self-directed IRAs. We'd love to have them as just as any other investment on the platform, as small as you'd like. There is a little bit of more paperwork involved, because you have to not just sign the subscription form as an investor, your custodian has to sign, but it's not that complicated. And but yeah, I want to mention one other thing, Danny, before I forget. So you're in these somewhat illiquid, huge alternative investment funds, that the two Blue Rock deals on our platform, for example. How do you get out if you wanted to get out? Well, they have a quarterly share repurchase feature. Both of them do, where they can buy back up to 5% of the outstanding shares each calendar quarter, 20% per year. So if you wanted to get your money out, there is a quarterly, buyback option to all investors within the portfolio at whatever the then net asset value per share would be. So there's no discount per se. There's no block-up period, no discount. And the real estate one has been oversubscribed recently. There's been more than 5%. I don't know if I think that's going to. I personally think that's going to calm down. The private credit one has never even approached close to that 5% cap. So there is liquidity. It's just not a daily liquidity thing. So if you're looking as a potential investor into these deals, that's a question people have. Okay, I can get in, but now how the heck do I get out if I want to get out? And so they have these, and you would be advised as an investor through a letter saying, hey, we're buying back shares this quarter. If you'd like to do so, go to the website and fill in this form and everything else. So that's how people get out of these deals if they want to get out of these deals. So they're otherwise evergreen, never ending, never liquidating funds that Blue Rock and Blackstone and Ares, all these guys have. They just effectively grow forever. But that's how you get out if you wanted to cash out your shares.
And do they have do they give out K-1s at the end of the year?
It's a 1099 reporting entity,
Okay.
so it's much easier. Good question. That's another great question, actually. It's a much easier tax reporting thing than, say, a K1. A K1s, I'm still waiting for K1s on some deals. I mean, it's so frustrating every year. But 1099 is a one pager effectively. They're required by law to be sent out no later than January 31st. So yeah, early in the tax reporting season, you'd get your 1099 for the prior year, and it would give you. And the real estate one has tax benefits. The depreciation flows through to the customer. So you might have gotten, say, a 5.25% return, but you might only be taxed on 3% of that 5.25% because the balance was sheltered by depreciation. So there are tax benefits associated with the real estate one, not on the private credit one. But yeah, 1099, easy, seamless, quick, and not like a big pain in the butt. K1. I always have to track them down every year. I'm going to do a couple dozen deals, and it's just always, it's always a lot of work to track those things down. I know you're a sponsor yourself, so you probably issued thousands of K1s over the course of your career.
Yeah,
but
that's why
it's
I
a lot
asked,
of work. Yeah.
How does it work for everyone? I'm
Yeah.
trying to think of like what questions would somebody who's listening to us who doesn't, I mean, you and I understand all of this, but
Right.
somebody who's listening may not, right?
They should go to our website. We got a lot of literature on the website that talks about who we are, what we're doing. Blue Rock has its own website, very, very, a lot of information there. What's interesting is that I bet people ask me, well, can I just go to the Blue Rock website and buy these shares? The answer is no. They don't want to have any direct touch with a customer. They want all of their, and it's not just Blue Rock, Blackstone, all of these companies want to have some sort of, fiduciary, whether it's a licensed broker-dealer like we are, or a licensed registered investment advisor, REA, like others are. They want that licensed, intermediary between them and the customer. So if you want to invest, say, $100,000 in one of these deals, Danny, it'd be incumbent upon us to make sure you're sure this is not too much for you, Danny. So, well, I've got $200,000 in savings. We'd have to tell you that's too much. You can't put put half your savings in this deal. Maybe 5%, 10%, 15%, but not 100%. But the sponsor, Blue Rock, doesn't have to go through that. They want us as a broker dealer, in our instance, to kind of be the person that is vetting the customer and making sure this is appropriate for the customer. There's no suitability standards. The only vetting that would really come in if you came with an outsized amount of investment, that we have to kind of make sure that this 100 grand, you got 20 million saved. Well, 100 grand's fine.
It's not your last 100,000 that you're going all in on black.
Yeah, exactly. Yeah. Anyways, well, that's our story. Alture Funds, ALTUREFUNDS.com. All the stuff's there. Yeah, and Blue Rock, they've got a pretty extensive website themselves. They offer multiple products. The ones we're featuring are the private real estate one and the private credit one. So,
wow, yeah, I know that's a lot of good information, so that everybody knows that they have choices of investments where you can actually get greater yields that just going into maybe like a mutual fund or anything like that. Not giving advice here, but nevertheless there's options here. Now, you've shared a lot of great points, Harold. If somebody wanted to contact you directly and wanted to get a hold of you, how would you do that? How would they do that?
Harold, my name, HAROLD, at alturefunds.com. Send me an email. Happy to talk to anybody. And it's a good point you made about, Danny, regarding these sorts of alternative investment funds, because people have talked to me and say, well, geez, can't I just invest in a public New York Stock Exchange listed REIT? Isn't that the exact same thing? And a lot of people talk about this Vanguard Real Estate Index Fund ETF. I mean, it's the largest kind of index fund focus or ETF focused on publicly traded REITs. And I looked at the other day that the dividend yield's 4%. Blue Rock's paying 5.25%. But also the difference between the 52-week high and low of their share price, the high was $100, the low was $77 when I looked at 52-week high and low. So you're looking over the past 12 months, that share price went from up and down between $77 and $100, like a 30% spread. So you could want to get a 4% return on your money investing in this Vanguard. Its ticker is VNQ, Vera Nancy Queen, but this is huge volatility. So part of the appeal to alternative investments also is to kind of get out of public market volatility, because you can Yeah, I think that's a lot of reason people invest in alts is not just the enhanced yields, but also kind of, putting a portion of your capital into some sort of investment that's not subject to the ups and downs of the public markets. So,
Right. No, 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 that definitely makes sense. And then, like you said, if you have retirement funds that you don't need
yeah.
right away, you can get greater yields and it kind of compounds quicker
Right, right.
because you're not
Yeah,
taking
they
any
they they
tax.
pay dividend quarterly. So every quarter you get that. In fact, we on our website have a little calculator thing where you can figure out if I invested 10 grand today and reinvested all of my dividends, assuming the dividend didn't change or distribution
Hmm.
didn't change, it compounds quarterly. So it really escalates very quickly, and if you're looking at down the road, like say a kid's wedding or your retirement or kid's college, all these things that you want to think you should be saving for,
Hmm.
these alts are a great product for that. And Blue Rock's big, huge company, been around a long time, know what they're doing. Again, no guarantees in life, but for some of your money, our thesis is obviously some of your money
Hmm.
should be in uncorrelated, you know, uh, investments like alternatives and not correlated to the public markets,
Hmm.
and getting good yields in the meantime. So, yeah.
Right, right, right. So as we wrap up our interview, what does the next 6 to 12 months look like for you? What's exciting coming up?
God, there's so much geopolitical things going on in the world these days.
Yeah.
It's just kind of scary to think about it. I just hope as a country we just kind of, maintain our balance, and it's just so many scary things going on in the world. But I think you're a real estate guy, Danny, so maybe you'll have some of your own color on this as well. But I think real estate values have obviously fallen considerably over the last 2-3 years as interest rates rose. I
Hmm.
personally think they've bottomed out. I think that if it was me, I'd put money into real estate, because with the Blue Rock deal, for example, you get the distribution, but you also get the capital appreciation, which is
Hmm.
reflected in the net asset value per share. Who knows if it's going to go up or not? But my belief that I think we're bouncing on the bottom right now. And I'd put money to work in real estate if I'd say at a 10-year horizon, because we get back into an environment where you could get high single digit, low double digit, unlevered yields in real estate. Just because I think they've fallen considerably over the last couple of years, and I think they're going to go back up and then some. So I'd be a proponent of putting money into real estate personally. As far as what everything else holds, gosh, that's a great question. Real estate, I think things have bottomed out. CLOs are collateralized loan obligations, which is the featured investment within Blue Rock's private credit fund.
Hmm.
They're yielding the great yields. Those are kind of floating rate. So if rates come down, those yields will probably come down. Quite frankly, kind of they kind of a spread above whatever interest rates are. But that's okay. I mean, that's a great investment as well. Probably a lot less risk to principal there than in real estate. Real estate values go up and down. Those loans, for floating rate, they should pretty much not change in value regardless of what other rates do outside of that. So I think we're bouncing along the bottom in real estate.
Hmm.
It's been tough the last couple of years, no doubt. Not talking about your personal home, which in Orange County, I'm sure just gone through the roof in that time frame. But commercial real estate in general across the country, I think
Right.
has taken a hit because of higher interest rates. I think now's the time to kind of put some money back into it. That's my personal belief. No guarantees, obviously, in life, and certainly
Right.
whatever my personal beliefs are.
Uh,
Yeah, yeah. I
yeah.
mean,
I,
what's your take on real estate?
I agree with you. I think the last 3 years have been rough years. I think the change is going to start next year in 2026. I think 2025 will be flat pretty much and kind of coming along the bottom, 24, 25. But I think 26 is going to be the game changer a little bit. And I think part of that catalyst is all that new supply that's being built in the large metros. There's going to be a huge drop off because the developers stopped building because of the high interest rates.
Right.
And I think we're going to get maybe like a 3 to 5 year window before the rates become favorable enough so that they can start building again.
Yeah.
And when that happens, because we still have population growth, we have businesses growing, we have people moving into all these these different cities and states, Arizona, Texas, Florida, Nevada. It's just like amazing what's going on there. And as long as that continues, and if you have a drop off in new product, you'll have a demand. Your market occupancy will rise, and that's when rentals start increasing, and now you have higher cash flow. And then if the administration is able to get the interest rates down, now we get cap rate compression, and there we go again. Start of the cycle, get appreciation. And so it's like, even though it's tough to buy now, anything you buy now that is a good deal for today, of course, will appreciate, and you would hope that with that it kind of blows our projections out of the water. You
Right.
don't know, right? You don't know, but
You don't know, but you and I both have lived through multiple cycles in the commercial real estate world. Global financial crisis being the most recent. Well, for this one, the global financial crisis. So the boom after the global financial crisis, was great. And the Blue Rocks deal, for example, the real estate deal. Again, no guarantees. It's not investment advice. Whatever all the requisite disclosures are, you need to say. But that's a good place to put some money right now, in my opinion, because I do believe that real estate, has bottomed out and will go up. And the Blue Rock deal is $4 billion deal. It's diversified a ton of real estate,
Right,
and
right.
so it's not just they own an office building in downtown Los Angeles. No, they own interests in thousands of properties all over the country: multifamily, industrial, logistics, data centers, senior citizen facilities,
Right.
Multifamily. I've already said multifamily, single family. All these asset classes that
Right.
they've been in this business for decades, and they actively manage this portfolio. So that's where I would park some money, because I do believe real estate is, kind of bumping along bottom right now. And I do believe when Powell's out, I think early next year, first quarter next year, and if the administration puts in a little more pliable Fed chair, I think then the pressure to reduce rates is going to be even more intense.
Correct. I agree.
Yeah.
Wow, we can talk about
Anyway,
this all day.
Hey, great minds think alike, Danny.
Yeah,
right?
yeah, exactly.
Well, you and I are both longtime real estate veterans, so we kind of we've seen it all over the course of our careers. So,
Right.
but again, who the heck knows? History doesn't always repeat itself. But the real estate is cyclical for sure. So
Yeah.
yeah,
And it's still exciting. I still get excited talking about it, seeing it, being in it.
Yeah.
It's the adrenaline that pumps in. Just it's fun. It's fun.
Yeah.
So, okay, very
Right.
good, Harold. Well, thank you so much for sharing so much insight and sharing your fund with us.
Yeah.
So that anybody who's listening to us, you can go to your website. You want to say the website again one more time?
Alturefunds.com. ALT, like alternative investments. Alture, ALTURE, funds, FUNDS.com. And my email address is harold@alturefunds.com. So reach out to me personally if you're interested in anything, or I can answer any other questions. So, but yeah.
Yeah, perfect,
Awesome.
Harold. Thank you so much for that.
Thank you, Danny. Very nice seeing you. Thanks for having me on your show.
Yes, and thank you to our audience. Please go to ocpowerplayers.com and follow us on your favorite channel. All right, Harold, thank you.
Thanks again.
Thanks for listening to Orange County Power Players. Want to share your success story? Apply to be a guest at ocpowerplayers.com/guest.